Hey, what's going on YouTube? My name is Gabe Bowling and welcome back to another YouTube video. We're going to be doing a performance update on Daytona Palms, a 55 unit deal that we bought in June of 2022. It was actually my first deal after I quit working for billionaire Grant Cardone. I bought it last year with a partner in June. We paid $8.2 million for it. 55 units over in Daytona Beach, Florida. And so now we're approaching June of 2023, and I felt the need to do a performance update because of one, I'm very happy with the performance overall. But more importantly, nobody ever talks about operations and performance. Everybody always talks about the acquisition, how cool it was, and how much they got in their acquisition fee, and all this madness. But I really wanted to pull back the curtain. I wanted to show you the inside of the operations. How am I tracking the performance? And overall, how the hell are we actually going to make money on this deal for the investors and ourselves? So with that being said, let's go ahead and let's jump right in. Really quick before we jump in, if you don't know who I am, my name is Gabe Bowling. I'm a 25-year-old real estate entrepreneur. And like I said, I did work for the billionaire Grant Cardone and Cardone Capital for about 3 years, and I raised over $100 million working there. And so I got a lot of exposure to the private equity space that we're playing, and I went through a ton of transactions, billions of dollars of transactions to be specific, and I broke off in February of 2022. So it's officially been over a year and a couple of months, and since then we control a little over $10 million of real estate, and we're helping hundreds of people all throughout the country buy apartment deals as well. And so we're very active all throughout the country on this deal specifically and on multiple deals in multiple markets. And I share that with you not necessarily just to brag, and I want you guys to completely understand this is what I'm doing every single day of the week, of all sizes of deals from 16 to 32 to 100 to 200 plus unit deals all throughout the entire country. And so now with that being said, let's go ahead, let's jump in, let's check out Daytona Palms, what's happened over the last year. And so I'm outlining two components of the deal, when we bought it and what we've done. And really there's multiple ways to track performance, and there's different metrics that you can look at. You can track NOI, you can track occupancy, you can track all these different metrics, right? The thing that I'm tracking all the time is the rent roll. To give you a baseline of what we bought whenever we bought the deal last year in June, really how you should look at this when looking at performance of multifamily assets is it's all return driven, right? So the business is you're raising money from investors, you're going and you're deploying the capital into businesses or multifamily apartment complexes, right? Produces income, and you have a 5-year or a 10-year projection to buy an asset and do something to it and be able to sell it for more in the future. So it's all accretive, right? You buy it for X, you think you can do Y to it to achieve Z, which is the result of the returns that you're looking for. So that's how you should judge and you should look at multifamily investing in general. Really, that's private equity investing in general. We bought this property, 913 Catherine Ave. I'll put a screenshot of the property right here. That's the most beautiful part about real estate. You cannot fake it. 913 Catherine Ave in Daytona Beach, Florida. Beautiful townhome deal, 55 units. They're all 2 1.5 bedroom townhomes. They walk inside through the front. They go through the back door. There's a ton of greenery. Like, it's an amazing deal with a ton of character. And it's the only one, it's the only townhome apartment deal in that area. So we have a lot of pricing advantage to that. And it all correlates to what I'm about to show you. So we bought the property in June of 2022. We paid $8.2 million for it. And our debt, just so everybody knows right now, there's a lot of variable rate debt that's hurting a lot of people. We closed that deal at 58% leverage. So we bought it for 8.2. Our loan was 4.8, almost a $5 million loan, and it was fixed for the next 5 years, interest only for 1 year, and we're fixed at 3.87%, which is phenomenal looking back today, what you see interest rates are at. So we're actually doing really well. Our interest payment is the exact same every month when other people are going skyrocket, like through the roof, doubling and tripling just because of interest rate movement. So that's huge. It's a huge win for our investors. We're currently paying out 6.5% net to the investors, which is incredible. So we bought the deal in June, right? And just so you know, if you invested in that deal, if you had a conversation with me about that deal, I told you, hey, I think we're between 5 to 6% for cash flow in the first year. Our first distribution was 6% to the investor, and now we're at 6.5%. And it's clearly going up because the business plan is going well. And so our projections, our business plan, just so you can have the baseline of what we expected and the way that we manage our expectations going into a deal, is we bought an average rent of $1,008. So now I'm going to move over to the whiteboard just so you can see the picture. So we bought the property for $8.2 million, 55 units, and the average in-place rent was $1,008, and our projection was to take it to $1,400 over the next 5 years, right? That's our projection. And then this is another metric that we track very, very, very closely. The rent roll that we purchased was $55,000 a month, and we are roughly, I think by June, on the pre-lease right now, I think we're at 67. I got to fact check this, but I'm pretty sure we're at $67,000, very close to it. And that's literally 12 months after. That's one way that we track the performance. So this is current, the rent roll. This is the projections of what we thought we would be able to take the rents to, $1,008 to $1,400 over that 5-year period. I am happy to report that the first lease that we actually signed on the property after we took over was $1,400, and then the next lease was $1,500. And so now we're at $1,500 for all of the leases that are new, which is incredible, just so you can understand that. When I talked to an investor, I said, hey, Mr. Investor, we target 15% returns, right? And in order for us to achieve that 15%, we have to be able to take rents from $1,008 to $1,400 over the next 5 years. And so you can only imagine the phone call and how happy everybody is when the next week after we close, I say, hey, we already got a lease at $1,400. And then now we're $100 above that. To simplify that, there's new leases that come in. So somebody moves, they give you a notice to vacate, and then they elect not to renew. That person moves out, and then we fill the building, or we fill that unit up with a new lease. Those new leases are $1,500. And then the majority of the tenants, just so you know, another metric for the operational side is the renewal rate. So if you take over, how many of those tenants that you're buying the lease, right? How many of those tenants renew with you? And so our renewal rate is 75%. Of all of the leases, close to 75, I think it's 73 or 74%, of all the leases that have come up over the last 11 or 12 months, 75% of the people have renewed. And so we're not taking them all the way to 1,500, we're taking them halfway. So we'll go half on the first year, then half on the second year. That's typically what you see on the operations side. And so moving on, really just to show you kind of, the money, which I'm imagining a lot of you guys are like, okay, well, that's cool. You're doing really well on the performance, but like, what does that mean for the deal? What does that mean for the investors and the return and the value that you're creating to the properties? Number one, we're getting cash flows. We invested $4 million of equity. What's 6.5% of $4 million, right? Because this is what we're paying out in cash distributions. Not many people think about this. Whenever you're in the value add space, you think about what you can sell it for. But with my criteria, I buy cash flow too. I mean, my deals have the cash flow day one, immediately. So if you take 6.5% for the cash flow, that's 260 grand, call it 250 a year in cash flow that you're receiving every year to own the building. And then really the big nut where you make the most of your money in value add multifamily deals is the upside. And so keep in mind, this is a 5-year business plan. We are less than 1 year total of owning this property. I'm just going to show you the difference, and this is where the rent roll starts to come in. Now, remember, I just want to remind you, when we bought it, the rent roll, let's call that PURC, purchase, all right, cool. The rent roll when purchased was $55,000, right? This was what we bought. Now, accretively to it, we've owned it for less than a year. I'm going to use June's rent roll because we're filling up a few units right now. June of 23 should be $67,000 of total rent being collected every single month. This is a 12 or 13,000? Yeah, 13? No, 12. $12,000 difference. This is where the money is made. Moving the rent roll, $12,000 a month. Granted, is 55 units. That's what number of doors matter. 55 units is a lot. If you think 55 units is a lot, think of 250 or 275 or 312 or 530. Like, these deals get massive the bigger that you go. And so Let's do the math. I want to show you guys the math behind, where really, truly millionaires and billionaires are created in this business. And so the math behind it is, keep in mind, we've moved the rent roll $12,000 per month, which is annualized. All numbers really in multifamily and just commercial real estate is always going to be annualized for values. $144,000 of new additional income. And keep in mind, this is about, I'd say, 60% renewal, right? So we're going to get another chunk, I'd say, next year after we've turned the rent roll again and gotten all of the second renewals. So I think this number is probably closer to 300 grand once everything's all said and done. So just keep this in mind. $144,000 of new income. All I'm going to do to figure out for new value is I'm going to take it, I'm going to divide it by, call it a market cap rate. Cap rates made up based on the cost of the debt and the spread in which the borrower is going to borrow the money over. But let's just say cost of debt today is 5.5 going to 6% with all this craziness that's going on. So let's just call it a 6 cap. We're going to take 144 grand, 144 divided by 0.06 to figure for our new value. And I think this is, let's do the math. I'll do it with you guys. So 144,000 bucks. 1 second, 144, $144,000 divided by 0.06, $2.4 million of additional value. In layman terms, if you're not up to speed with multifamily, you don't understand the lingo, basically we've added $144,000 of new additional income. And so who you sell these deals to and who invests in apartment complexes are investors that are looking for yield. People that are looking for returns on their cash invested. And so because we increase the amount of income that the property generates, we increase the value we increase the value of the property because people are willing to pay for the income that a property generates. That's really the biggest difference between commercial real estate and residential. Like, nobody cares about the backsplashes or the tile or the size of the backyard for their kids. In commercial real estate, it's all how much income does this asset produce, and what if we do this backsplash, how much new income can we get? That's the biggest difference. There's very, very, very little emotion tied to commercial real estate and a ton of emotion tied to residential real estate. I'm going to show you guys what this actually does to the investors and really returns, because as a multifamily investor, if you're going to do this business actively, if you're just, in your main gig, you own a business, you're making money somehow, you're happy, with your current lifestyle, just invest passively, like make more money and invest passively with guys like me into deals. You retain 80% of the ownership as a passive investor and you do no work. You're going to kind of have an insight to overall returns and what's possible in the space as a passive investor. So just keep in mind, this $4 million is the total equity that we invested into the deal. And so as an investor, how to solve for returns is you invest $1, how much do you get back over what period of time, right? So if you invest $1 and you get back $2 over a 2-year period, well, that's 100% return because you invested $1 and you got another $1 back. So $1 in, $2 out, that's 100% return. And it took you 2 years to do that. And so if you take 100% and divide it by 2 years, that is a 50% return per year. That is like this most simplest way to understand returns. We invested $4 million into this property and we have we have a much longer time horizon. We don't have to exit the deal until year 10. But we want to get it in and out between years 3 and 5. That's our motto. If we can turn the money every 3 to 5 years, we love it. Keep in mind, this is only 1 year of ownership. We've increased the value theoretically, right? We're not selling it. We're not doing a refi. We're not doing anything right now other than just continuing to perform and continue to operate as is. But if we look at the difference between the rent roll that we bought in June of 2022 and then now of 2023, we think we've added close to $2.4 million of value to the asset. And that's at a 6, maybe 5.5. It could be more. All I'm going to do to solve for high level, equity growth or potential equity growth is I'm just going to divide the 2.4 divided by the $4 million. Like, okay, well, immediately, if I just scratch the 4, let's just say it's $2 million of upside. Well, that's a 50% increase on the equity invested in less than a year. Now, we can't realize that right? Because we have the loan, we have prepayment penalty of maybe 3 or 4%. And honestly, we don't want to sell right now. Today's a terrible time to sell as a seller. And there's still so much more that we not necessarily have to do, but we are leaving a significant amount of money on the table if we exit right now. And so by no means are we going to exit, even though we have this gain right here. But it's good to know about it, right? What we're going to do is we're going to continue the business plan. Let's say the 150 or 144 turns into 300, and this 2.4 million turns to 5. Now you can see $5 million of upside or increased value over the next, another 12, another 18, maybe 24 months total. So within 36 months of purchasing the asset, we invested $4 million and we increased the value of the property by $5 million. That is a double up and some on just the upside, the appreciation, and we get the cash flow while we're waiting. We started at 6, we're at 6.5. I'm sure that's going to go up to 7, maybe even more. Like who knows? That's 7% a year. So you can start to understand where average industry returns as a passive investor, not active. What I do is active. I help people learn the business to become active investors or syndicators. Most people will start in smaller deals and work up. Most people that are happy with their job or their business, they're making a bunch of money in their main profession, they become passive investors, and 15 to 20% annualized returns are very average industry standard for great operators. Very, very, very large statement. Take it with a grain of salt. Apologize for the ugliness. Take it with a grain of salt. 15 to 20% returns with great operators that have been doing it for some time. Like even myself, I shoot myself in the foot by saying that. I would be skeptical to invest with myself until I learned who I am, right? I have complete confidence in my ability to produce these returns because of the exposure to the game that we've had. I've gone through 19 transactions of $50 million up to $750 million, and I've done this deal, and we're performing. This is real data. This is pulled directly from the rent roll on the property today. And so we're very open about it. Let's put it like this, in order to be this confident, you have to be very open and very honest and very ethical about what you're doing, and you just show, you don't tell. And so I show everything that we're doing. Every single investor in the deal, every single quarter, I send out updates with the books. I share the books, I share the rent roll, and I share the T12 with every investor in the deal. I don't know where that even came up. If you're a passive investor, make sure you're vetting out the operator. But once you do find good operators that are reputable and have done this before and can consistently hit good returns, they typically should be between 15 to 20 to the investors. And then for the active investors, it's just like you become a business owner. You can make a ton of money doing it and becoming the active investor, but there's such a large learning curve that you have to go through, and you have to put in tons of reps to even find the first deal. It is very, 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 very rewarding, and you can make a ton of money doing it. You just have to grip into the education. You have to find somebody who's done it and somebody who can help pull you up through your first deal and get you started. Because once you get started, you do not stop. And so as of a year later, that is what we've successfully done to the property. As you can tell, we're very happy with the performance of it. We're paying cash flow. One of the very few operators that are still paying out distributions, which we're very happy about. We're getting our rent increases. We projected that it would take us 5 years. I think we hit the total within the first 24 to 36 months because of the way that we projected and how conservative and how disciplined we are with understanding the business plan. And so all in all, to say the least, guys, we are going to do phenomenal for the investors on that deal. It's a great first one out of the gate, and now we're prepping for the next deals to come over the next 12 to 24 months because I'm seeing them as of literally right this second. Deals are truly coming out. I'm starting to see a ton of distress in the marketplace, and it's good. You know, the people that are prepared are going to be able to take advantage of buying deals for 30, some 40% of a discount comparison to where they were at literally 12 months ago. So it's going to be great. My goal is to take you guys along the ride and show you guys every single part of the business, pull the curtain back and give you guys the truth behind getting into and starting and launching a successful real estate business and I'm going to bring you guys along the entire thing. If you guys found any value in today's video, all I ask that you guys like, comment, and subscribe. Most importantly, subscribe. Help me get this information out there to everybody who needs to see it. And then secondly, if you guys are interested in learning the business and becoming more active and going through learning all the terminology, learning how to underwrite deals, learning how to raise capital, everything, I do have a ton of educational products going on. We have a completely free 2-hour-long course. I'll put all of the links below in the description. We have a completely free 2-hour-long course. We just launched the Deal Room University, which is literally like, if the free course is just dipping your toe in the water, the Deal Room University is 15 hours of extremely detailed education. That's like jumping into like the middle ground, maybe the 6 foot or 8 foot deep end. And then the Deal Room is a 12-month long coaching program that I run. We meet twice a week, and that is literally jumping into the deep end. So that's only for people that want to become active investors and going out, finding the deals and putting everything together. Stay close here. I'm going to be coming with new YouTube videos all the time going over multifamily deals. And so with that being said, I appreciate you guys, and I will see you guys next time.